Why are costs so high in the early years of an IUL policy? Well, in this episode, get ready, I'm going to explain that a property structured max funded IUL is probably one of the most least cost, least expensive financial instruments you could ever choose for long range goals. You don't want to get confused between choosing short-term investment for long-range goals or long-term investments for short-range goals. So get ready. I think you'll gain insights into why IUL is one of my favorite financial vehicles, because it ends up being the least expensive vehicle for most people. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic wealth. My favorite financial vehicle, without question, if you've watched very many of my episodes on this channel, is a properly structured, max-funded, indexed universal life insurance contract. And if it's structured correctly and funded properly, it is deemed a laser fund, which is the title of my most recent best-selling 300-page book, which I will gift you a copy of this at the end of this episode. You don't have to pay $20 for it on Amazon. I'll gift you a copy free, so stay with me here. So people oftentimes get concerned. They look at the IUL proposal, the illustrations, and they go, hey, why are the costs so high during the early years of an IUL policy? Because they will see that if you put in, the maximum amount allowed by the IRS for an older person, because probably the sweet spot of people that we have helped for years are those that are age 55 to age 75 that are preparing for retirement, and they don't want to outlive their money. And they're doing strategic rollouts out of their IRAs and 401ks because they realize they're not going to be in a lower tax bracket. And they're going to put the money into a property structured IUL. So they may deposit, let's say, $100,000 a year for 5 years, a total of $500,000. That's the guideline single premium. And with $500,000, you could get a ton of life insurance death benefit, but that's not the objective. When you're using IUL for living benefits, which is what it was designed for in the first place, that's your primary objective, you're usually taking the least amount of insurance you can get away with under IRS rules, and you're putting in the most money the IRS allows as fast as they allow. Now, it's designed for long-term goals. Now, when I say long-term, I'm usually talking about a goal, a financial goal that's going to be 5 years or longer down the road. So let me start off answering this question by telling you the biggest mistake I see most Americans making when they're saving and investing money. They are making the mistake of choosing long-term investments for short-range goals, okay? In other words, a short-range goal might be saving for a baby or a house, or to buy a piano here in a year or two or whatever. You generally do not take out an IUL policy, a long-term investment or a mutual fund or something like that for a short-range goal, okay? That should be a bank or credit union probably, okay? But a lot of people, they use short-term investments for long-range goals, or the opposite. They use short-term investments like a bank or credit union for long-range goals such as retirement. Don't mix those two up. You should be using long-term investments for long-range goals. Now, a max-funded indexed universal life is for long-term, long-range goals. Those are usually 5 years or longer down the road. Can you dip into it sooner than that? Of course. But you're designing it for income, tax-free accumulation and tax-free income that will last you for several years, all through the rest of your life. For retirement is what most of my clients do. So first of all, you've got to look at it that way. You're looking at it as a long-term investment. Quit looking at it during the early years. So this is why I usually recommend or say to people, you choose investments based upon the ones that will generate the most at the time in life you're going to be needing or using that money the most, okay? And so if you're taking out an IUL policy as an alternative to an IRA or 401k, then that's a long-range goal. And so you're going to choose which one is better. And if you compare to mutual funds or or annuities or IRAs and 401ks. You look at an IUL and it will actually knock the socks off of those alternatives for long-range goals because of what it generates. It generates the most at the time in life you're going to be needing the money the most if you structure it correctly. So, for example, if I set aside $500,000 into an IUL policy in accordance with IRS guidelines, I'm talking about the TAMRA tax citation. So I might only be able to put in $100,000 a year, $100,000 the first day of the first year, $100,000 the first day of the second year. So in 4 years and 1 day into the 5th year, I've got my $500,000, the maximum amount allowed into that policy. Now that $500,000 for most of my clients have been averaging about 9.62% ever since 1980 when Universal Life was first introduced by E.F. Hutton for living benefits. And so that $500,000 at 9.6% divided into the rule of 72 will double to $1 million in 7.5 years. So 7.5 years on top of 4 years and 1 day. Many of my clients, they have now doubled their money in the first 11.5 years or more. And let's say you have $1 million and now you want to start taking out income. Well, if you study the YouTube videos on this channel and you read the book I'm going to gift you at the end, you'll realize that every $1 million that you accumulate in a property structured max funded IUL can generate an 8, 9, 10% payout, okay, $100,000 a year of tax-free income from age, 65, age 70, age 75, all the way to age 120 without running out, okay? You compare that to most investments like mutual funds, annuities, and what have you. Many of them will not generate as much income, or if they tried to generate the same amount of income, they would crash and burn. They would run out. And so the second concept is you choose investments based upon which ones generate the most. The reason why IUL is so great is because I only have to earn an average of 11% by diversifying and rebalancing every year, which is what I've done, okay, to net 10. So I can pull out 10% a year, and I can do that to age 120. If I did that in a IRA or 401k invested in the market in a mutual fund, I would have to be earning at least 15% before tax to net 10% in a 33% bracket. In order to net $100,000, I'd have to be withdrawing $150,000 a year out of $1 million nest egg to net $100,000 to buy gas and groceries. That $1 million nest egg, even if it was earning 10%, would run out, be drained dry in 11 years. If you only pulled out $100,000 and you have to pay tax on it, you're only netting maybe $67,000 or $70,000. And so you don't have as much net spendable income. You're choosing which one's going to give you the most, generate the most. The IUL can generate $100,000 a year tax-free. An IRA or 401k earning the same rate of return would only net you maybe $67,000 instead of $100,000. Are you getting it? In other words, 50% more. $100,000 is 50% more than $66,000 or $67,000. Now, you need to understand also that if you really are concerned about accessing money during the first few years of an IUL policy, and you want the liquidity, you want 100% access to the accumulation value, okay? The accumulation value is the amount that you put in there minus any fees and the interest that you're earning on that. During the early years, usually there is a difference between the accumulation value and what is called the surrender value, which usually there's a surrender charge or fee during the first maybe 10 years of most IUL policies. Some even go 15 years before the surrender value equals the accumulation value. The surrender value only comes into play if you're accessing money or you're going to cancel the policy. If you're worried about accessing as much money as you can, or you think, oh man, I may have to cancel this policy in the early years, well then you could actually have a waiver of surrender where you can have 100% access to the accumulation value. So you can do that to have liquidity so that the costs are not so high in the early years. However, there is a sort of a hidden cost to that waiver of surrender, and they spread it out over the life of the policy. So there's always trade-offs. If you want to have the best net internal rate of return over the life of the policy, over 20, 30, 40 years, clear until retirement and to age 100, age 120, if you want to earn within 1% of the gross rate of return, so for ever since 1980, I have averaged 11.17 gross because I diversify and rebalance on an annual basis. And so if you earn 11, I can show you retroactive back to day one, you'll net within 1% of the gross rate of return, you'll net 10. That's why for every $1 million, you can generate $100,000 a year of income if you're netting 10% cash on cash. Well, that's if you don't worry about the costs in the first few years, because it really comes back to you throughout the life of the policy. If you chose to have a waiver of surrender fee rider or what have you during the early years, if you earned 11 over the long haul, you might only net 9.5 instead of 10. So you're going to give up on the back end. The trade-off is you're going to give up some of the internal rate of return if you want 100% liquidity during the early years. Most of my clients didn't care about that. They were using this as a long-term vehicle, okay? So acquisition costs are usually more in the early years when you first take one out, because you've got underwriting expenses, okay, by the insurance company. You have compensation, which is paid out to the licensed agent. Now, that compensation is only paid out to a licensed agent on the new money that goes in. All the money you make on an IUL throughout the years, the agent doesn't get compensated on that. Like an asset manager, they keep charging you 1 or 1.5% on the assets they have under management every single year, whether they made money for you or not. And so remember that as I complete a little bit more here in a moment. And so you have to recoup those acquisition costs that are incurred during the early years. But it's usually only during the first, 5 years if you're maximum funding that contract. If you're putting in $100,000 a year for 5 years, then the licensed agent is getting compensated only on that money, the new money that you put in. All the money you make through the years after that, the agent does not make one dime. So let me go back and use an example or a metaphor, an analogy to help you understand this. Let's say you were going to be buying a new home, and you told the realtor, hey, I want a $500,000 house. So the realtor finds you one, and the realtor says, now you know that realtor fees are 6%. So 6% on a $500,000 house is $30,000. Now, most of us sort of accept that. It's a standard realtor fee, right? And so that would be $30,000 on a $500,000 house. But what if the realtor said, now in lieu of 6% one time, you could pay me 1% on the value of that home every year, the rest of your life that you own that home. And if you've got to own it this many years, or else you got to make up for this. Now, if you really thought about it, which one would you choose? I'd rather pay the 6% once, okay, than 1% on the value of that home as it went up in value through the years. Why? I'm comparing this to IUL. Sometimes agents, other advisors say, oh man, the commission, the fees on those IULs are so expensive. No, it ends up being the least expensive vehicle for most Americans saving for retirement. Let's say you started out with $500,000 into an IUL policy. Well, that agent might be compensated on that first $500,000 that goes in, okay, new money, and it's probably around that 6%, $30,000, okay? And so that's all there is. And then that $500,000, if they earned a rate of return like I have, and many of my clients have, where that doubles about every 7.5 years, $500,000 doubles to $1 million. And then $1 million would double to $2 million in another 7.5 years by the 15th year. It doubles to $4 million and by the 22nd and a half year, doubles to $8 million by the 30th year. Many of my clients with IUL started out with $500,000 and they now have $8 million. I only got compensated on the original $500,000, okay? Now, that was a one-time, $30,000 during when they first took it out. Now, if I was an asset manager, I would have been charging them on that $500,000 1% or more every year. Now, if they did the same thing and doubled that to $1 million, then to $2 million, then to $4 million, then to $8 million over the same 30-year period, that would be pretty awesome. I've seen very few asset managers do that. But charging you 1% every year on those assets under management, the fees would have been $980,000, nearly $1 million compared to $30,000. So when people say, why are the costs so high in the early years? Well, that's because of the acquisition and so forth, but it's only on the new money that goes in. And after that, it's the least expensive. It actually gets cheaper as you get older. So that retroactive back to day one, if you were earning 11, you'll net 10 cash on cash. Only 1% goes out for all costs. The cost of the insurance risk if you die, the cost of all acquisition, commissions, whatever you want to say, all of the policy fees, the commissions, the acquisition, the underwriting, all of that ends up becoming minuscule, only a very small amount when you look at the results that are achieved over the long haul. Does that make sense? And so that's why I would rather, incur a one-time, fee of like 6% only on new money than to be charged a 1% or more on the value of my investment every single year the rest of my life, even if they didn't make me money. That's how asset managers work. I've never liked that model personally. And so you have to rethink your thinking. If you want to learn more about how to properly structure a max-funded IUL and why you can see over the long haul is probably the least expensive, because when you see all the illustrations, you'll see all the fees and costs that are associated with that through the years, and you'll see if it's structured correctly, it actually gets cheaper as you get older. So if you want to learn more, the first thing to do would be to claim a free copy of my most recent 300-page best-selling book, The Laser Fund, which is actually 2 books in one. This side is for the left brain learner, 200 pages, 14 chapters with all the charts and graphs and explanations. If you're more of a right brain learner, you learn more by stories and examples, you flip it over to this one. This is about 100 pages, 12 chapters with 62 chicken soup for the financial soul stories. If you want to use your left brain and your right brain, you can read both. But you simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll pay for the book. I will fire out a hard copy of this book to you via priority mail. Now, when you're in there claiming your free copy, if you like to listen and learn or watch and learn, check out those options. But you can also schedule to attend a free educational webinar. We do them on a regular basis. You can even schedule an appointment to talk to a professional certified IUL specialist to help you understand how to set one up correctly. There's no cost or obligation, but you can actually see how one is designed correctly so that the costs and fees are the cheapest over the long haul. This is extremely critical. You want to make sure it's done right from the word go.